Hey YouTube, this is Zach with Achilles Financial. Today is January 1st, the start of 2024, and I'm going to be walking through my 2024 investment themes, and this is all strictly my opinion. If you find this type of content helpful, please leave a like and subscribe. I'm looking forward to a much more active 2024 and hopeful that you can follow along. So my very first theme I've got up here is the S&P 500. This is going to be a bold claim. You can see at the beginning of the year, it started quite low, but what I would note is that I'm expecting a much larger shift in the narrative going into 2024 than the rampant rise that we saw in Q4 of this year. So if we are looking at the percentage change on the chart here, you can see that the S&P 500 was up north of 21% on the calendar year basis. And I think that if you are not a trader and you are simply an investor from a 401k perspective, that it's very difficult to beat the S&P 500 over the long term. So this walkthrough is not necessarily to say that this is a bad investment, more so to highlight from a trading perspective, this is what I'm looking to evaluate and should not be construed as advice. I'm just highlighting that this is what I'm looking to do. Keep in mind that most of this increase that we saw this calendar year really came in the second half of the year when the narrative started shifting surrounding the idea that we were going to have a lower interest rate return or lower interest rates in the future. At this point in time, that seems to be the dominant narrative, which has brought the S&P 500 up to be significantly higher than it's been over the past couple of years. So what that looks like on the ROI type of basis, if we plug this in here, is you can see that we have gotten much closer to those returns. You can see again on the 3-year chart from 1/1/2021 until 12/10/2023. Let's bring that all the way till the end of the year, where we hit those new highs or closed at those new highs. The question is this going to be a double top if we're looking at in technical terms? And I'm of the opinion that because so much of this was due in part to the Magnificent Seven stocks, that I would not be surprised to see some turnarounds in the fortunes of some of those stocks. We've already seen weakness from a marketplace perspective in stocks such as Apple and in Nvidia and even in Tesla, and 3 of those Magnificent Seven, where we could start to see market conditions cause a decline in the overall, or rather the underlying fundamentals associated with those businesses, which could cause a negative return for those individual stocks, which would drag down quite a few of these indices. Now, keep in mind that a 10% reduction in the stock price from where it's at today of that $475 mark, again, looking at the S&P 500 right here, a 10% reduction would bring that stock down back to levels not really seen since November of this year. So the reason why I highlight that is the idea that we're bringing back to these levels is not something that should be crazy because it's only back to levels not seen since November. Now, if we were to get a little bit crazier and go down into the 20% reduction that happened at the end of October, as well as earlier in 2023. So I think that the fortunes of some of the larger companies that have really launched this higher, such as the Apples of the world, such as I'll bring it down here and showcase some of the companies, Apple being the largest holding, Nvidia being another large holding, and then Tesla. I think those 3 companies could struggle in 2024. That would weigh heavily on the overall stock market, but in particular the S&P 500 or QQQ. In addition to that being investment theme number 1, what I would highlight my second investment theme is going to be that cash will continue to be an excellent option as an investment platform. So what I'm showcasing here on the screen, representative of 3, 6, 9 month, 1 years, that's going to be a good option. Most of these has dropped quite materially. But what I would note is that right now for most CDs, I currently have a high yield savings account with Discover that's currently offering a 4.35% ROI, or a yield at the very least. And what I would note is when you're evaluating these different yields available here for a CD, you can still get greater than 5% on the 9 month and the 1 year, And if you come down, even US treasuries are still pretty close to that 5%, although not quite there, but there are different tax benefits associated with the US treasuries. The reason why I highlight this is because if you have larger sums of money, if you're an older individual, if your goal is capital conservation versus large returns on your investments, I think it is very difficult to look at these returns over the next 1 year and say that that would not be a safe investment. Again, treasuries are essentially a risk-free rate, recognizing that the only way that this turns bad is if the US government is defaulting on its debt, at which point in time we would have a lot larger worries to be associated with this. In line with some of the cash returns and some of the capabilities that you have and what I'm showcasing here on the screen, one of the additional investment theses I have for 2024 is that we are going to see the yield curve uninvert. At this point in time, you can see the 10-year yield for US Treasuries is 3.87, whereas if I go out into the short term, the 1 year is 4.8. Generally speaking, if I'm evaluating risk profiles, to hold something for a longer period of time carries more risk, which is one of the reasons why if you were to get a mortgage, a 15-year mortgage is going to be a lower interest rate than a 30-year mortgage, because the bank is assuming more risk to hold your money for a longer period of time or to lend you money for a longer period of time. Because of that, there is a large concern whenever you see short-term bonds are at a higher interest rate than longer-term bonds, because that means that there is a higher risk associated with the shorter-term evaluation. Historically, whenever there has been an inverted yield curve, there has always been a recession. Now, the caveat to that is there's not necessarily always a timeline associated with that. That could be 18 months after it initially inverts, which would be in the middle of 2024. Could be 24 months. So even though there is the statement where it's always going to be higher, I would note that there is some caveats associated with that. But if we go into a recession this year, I would expect these two values to uninvert, which I do think would be showcasing a negative impact on the US economy, and that would spook markets. Now, if these are dropping, I would highlight that that means that most likely interest rates will be dropping. However, whenever interest rates have dropped historically, we have seen the S&P 500 drop at the same time. So the last time we saw something like that would have been a 2018 time period where we were dropping interest rates. So if we were to showcase that, we don't even go back that far at this point in time, which just kind of showcases how long it's been since we've had interest rates dropping. So the last time we saw that, if we were to go back to January of 2017, you can see the drop in the 2018 timeframe. There was also some geopolitical issues with China, but this is the last time that we saw a drop in interest rates. We saw a drop in interest rates during this time frame. So the question is going to be, do we see another one should interest rates fall, which at this point in time, there is the expectation that will happen. So I don't think we're going to see an interest rate cut in Q1. I would not be surprised if there was a cut in Q2. So I've been highlighting the S&P 500 because this is something that carries a lot of weight. It's a large portion of many portfolios, whether using the S&P 500 as part of the SPY or the Vanguard Fund or Fidelity or some other broker. But what I would highlight is you can see on the right-hand side the different portfolios. So while I think SPY overall is going to drop in alignment with one of my prior videos, I think that you could see energy perform very well this year. The question's going to be, is it oil or uranium? And I think that oil is going to be a good trading vehicle. I don't know if I would consider it a long-term investment for this calendar year. And then I also think that you could see consumer staples as well as defense stocks, which aren't going to be necessarily on this screen, are going to perform very well as well. Again, the question is, does that mean the entire branch or the entire group of these sections are going to do well? Not necessarily, but I think there are going to be winners, and that's something that I'm going to be evaluating on a go-forward basis. So, with that being said, just to re-highlight some of this, I do think the S&P 500 is going to fall over 2024, We saw that happen in 2022, so it wouldn't, or rather, you wouldn't have to look back very far in the recent past for this to occur. But if that happens, I think it'll be a big deal. I don't think you're going to necessarily see a 30% reduction, but we could see a material drop. So the question is if that's going to be the case. If we see a fairly painful year, then how do we trade it? And I think you're going to see cash, despite a drop in interest rates and an uninverted yield curve. I think there's going to be opportunity, and as such, rolling 3-year treasuries or even just sitting the year out with cash on the sideline, I think is going to be beneficial. But if you're evaluating different investments, you don't necessarily have to short the market or buy puts. I think there's going to be quite a bit of options available in some of the categories. In particular, energy is what I'm going to be looking at, but consumer staples as well as defense stocks could be an option as well. So this is the first go round for the Zach Achilles financial views on what I think may be happening in the market in 2024. If you want to follow along, feel free to check out the Discord in the description down below. It's free to join, and we chat about a number of these things here. And in addition to that, please like and subscribe. Thanks for watching if you made it this long. Talk to you later.